Welcome to Property Showcase, the podcast that brings you closer to the service providers that can inform your decisions about how you buy, manage and research top investment opportunities. Be informed and become a better investor with Property Showcase.
G'day everyone and welcome back to another segment of the Property Showcase. I am your host, Tom Gilmore, Partnerships Manager here at Smart Property Investment. Jumping into today's topic, we're going to be focusing on the people who have been struggling to buy property over the past few months, or perhaps you're even currently struggling to buy a property. We're actually going to tell you why. And to help me with this topic, I have a favourite guest, star, you could almost call him, back in the studio with us here. His name is Arjun Paliwal. He's the Head of Research for InvestorKit. Arjun, how are you going?
Very good, Tom. Thanks for having me on.
Yeah, always a pleasure. So, Arjun, why have people been struggling to buy property right now?
Uncertainty is a big part from the buyer's end and the seller's end in terms of what we're seeing. So when you're talking uncertainty, just think of everything we've seen from March till now. We've seen many crazy headlines. We've seen events that have never happened before, widespread lockdown, global issues. And, I think from this response, naturally, we've also never seen, a response this big, right? And so that does a lot of things to both buyers and sellers. Now, with uncertainty, what that tends to result in is low amount of sellers, low stock. And with this low stock, the flow on impact to a buyer is that instead of having maybe 10 properties in a certain area, and there might be two, main road, busy road, or near a train line or in a flood zone, there might be 3 or 4 kind of a bit overpriced and difficult to buy because it's a little bit outside the budget. And then the final ones are sweet spot deals. They're right in the budget, they look good, and you're trying to make it work. Now imagine all those ratios halved, if not a quarter. And guess what? The ones that were always pretty crappy are still trying to sell in terms of the train lines or, the main roads or floods. And so now you're like 1 in 4 of a property. And then when you have so many people fight for it, sometimes it's a lot of people not putting in the right offer and the vendor just doesn't want to go down. Sometimes it's a lot of people putting in the right dollars and you're breaking records and you miss out. So that's the biggest part. I mean, there's many smaller data points and all the numbers we can go through, but the biggest part is uncertainty creates low stock, and low stock removes a lot of good stock, and you're left with a bit of rubbish stock as well.
Yeah, absolutely. So I suppose that paints a pretty good picture of sort of what we're seeing. And to give credit to Arjun here, you do work, across the country. We're not just talking about Sydney markets here. We are expanding into places such as, I believe Bendigo was the most recent one on the podcast we heard last month as well. So uncertainty being the key word here, how are you tackling uncertainty for your clients right now?
Yeah, so when you first look at the uncertainty in the stock issues, you have to start by casting a wider net. Now, fortunately, we operate across multiple states, buying regional and capital assets. I mean, personally, half my property portfolios, regional and half capital, and also residential and commercial. And so when you cast a wider net, it's going to firstly reduce a lot of problems, because right now, so many buyers who are out there on their own trying to buy are typically looking at their backyard. And so when you have that stock reduction in your backyard, that then adds to the problem of buying. 3 months becomes 6, 6 becomes 9. Now, there shouldn't be any rush for anyone during this time period. I get that. But at the same time, if you keep going and keep going, we believe in buying windows. And, it's not like you could buy between 2012 and 17 in Sydney, which had that big uprise, and buying the best parts of it, which would have been 2012, every single year, all the time in your backyard. It just doesn't work. And so from casting a wider net, you access more locations. But something not many people are talking about is rental data. During times of uncertainty, is it really that uncertain for you when you have the right level of rents coming in frequently, not being missed, finding a tenant quickly, and being able to rent out that property to the right person? Because once you solve that issue, and you naturally are obviously looking for those capital growth locations, but once you really solve the rental data issue, you find yourself in a position to then actually navigate through uncertainty through holding an asset that continues to deliver cash flow, right? And so a perfect example of that is what we do from our rental data perspective. Typically, people only look for rent in the form of vacancy rate or in the form of rental yields. hey, will it be good to rent? And will I maybe, get a good yield from it? That's not enough in today's environment. You've really got to double down. So some examples of what people can do and what we're specifically doing is rental days on market. How often do we look at that? I don't care if a place has got a 1.5% vacancy rate if it still takes me longer than 3 weeks to find someone. Yep. So to me, that's my key. Rental days on market, vacancy rate, the percentage of owners versus renters, looking at stale listings, the count of properties over 21 days for rent versus this time last year and now. So finding those areas that's reduced like massively. Incoming building supply. So this is how we're tackling it. We're doubling down on rental, casting a wider net, and also understanding that we still need to find those growth locations. And if we really, take away where are areas where the job diversity might be a little bit, impacted during this time, where are jobs likely to be coming up more in certain areas, where, certain levels of affordability, lifestyle amenities being quite attractive during this time. So I think once we filter that, if you double down on rental data, but still on top of your traditional capital growth metrics, this is how you're going to tackle and buy during this period.
Arjun, I'm sort of inundated with, data, research from a combined number of sources, one being CoreLogic is quite an obvious one. And I hope a lot of people listening to this are obviously getting that data as well. But things like the data points that you've touched on, can people get their hands on something like that from you?
Yeah, so this is where we really, take our investment into data to a next level. And through our buyer's agency service that we traditionally, work with investors on, we're able to then go deep into this data, custom for their briefs, carve out a strategy that involves this wide net to be able to look at locations across the country. And as we do this macro research, we pinpoint areas using this data and push it down to the micro, because now we're talking suburbs, properties, neighborhoods. So from the different data sources that we pull in together, some on custom projects, some on subscription levels, some on deep dive analysis, as a result, we're able to pull this all together and create the story that's going to protect you and de-risk this journey for you whilst you're buying during these times.
I think the advantage as well, coming back to sort of being inundated with data points, is the human touch, which is actually an episode you've covered before quite well. And, I always come to you and I'm screaming at you trying to, I ask you all the time, can you please explain to me what all of this means and is this the right move? So in terms of being able to get a hold of this stuff or get in touch with you, how can people do that?
Yeah, so people can reach out via InvestorKit.com.au. And we are holding consultations at the moment, which are, free for people to be able to step into and just have that time to see where you're at and see this data in action. The blessings of COVID have meant that we've been able to actually have Zoom calls a lot more. And with the Zoom calls, it means that we're sharing a lot of research and data during these sessions. Traditionally, discussions with us were about, the fit with people or where they're at the journey, and not really being able to share as much data until they became our clients or worked with us. But now, as a result of Zoom and what we're doing now, we're bringing the data forward. We're showing people during these sessions what we're seeing across the country, and reaching out can definitely help with that.
So if just to sort of end on the conversation, the topic of the podcast, of course, is, people who have been struggling to buy property over the past few months or even currently. What are you going to do over the next 3 months to the end of the year? What are you going to do come 31st December? What are you going to do to help your clients?
Yeah, so I think as a result of this casting a wider net and, deep diving from the macro, micro, and on the ground, we're really doubling down on areas showing low stock, high buyer pressure. So buyers aren't just buying assets that they hope they can hold through this all, but they can actually come out the other side with capital growth as well. Because, during these times, not all areas are getting the same blanket approach. When migration or borders shut, people aren't coming from overseas and jumping on a plane and the first part they land on is Bendigo, right? Or a part in Adelaide in comparison to, Sydney and Melbourne, right? So certain regions are going to be impacted a little bit more or a little bit less. And I feel that as at December end, we're going to be looking back and saying we put ourselves and our clients in such a position where they're in markets that are far less impacted as a result of our buying decisions.
Yep, makes complete sense to me. All right, Arjun, how do people get in touch with you if they want to give you a call today?
Awesome. So again, you can just check out InvestorKit.com.au. We have a link there for requesting a consultation.
Fantastic. Easy as that then. You can also see Arjun across the Smart Property Investment Show if you want to tune into a few of his other episodes. Of course, we do rely on Arjun as a bit of a resource from time to time on editorial stories. He is a wealth of knowledge. So if you're a bit more of a reader, such as myself, you can always tune into smartpropertyinvestment.com.au to catch up on a few stories there. Arjun, thank you so much for joining us.
Thank you, Tom.
Well, g'day everyone, and welcome back to another segment of the Property Showcase. I'm your host, Tom Gilmore, Partnerships Manager of Smart Property Investment. You know, we've been banging on a lot about fear of missing out, COVID, uncertainty over the past few months on smartpropertyinvestment.com.au. And whilst all of that is quite important and we rely on the experts to fill us in with some of that information, I want to move into the direction more of execution and perhaps a bit more striking fear to you listeners tuning in right now, mainly just because a lot of discussions I've been having with investors, first-time buyers, perhaps even the savvy investor is they're either struggling to perhaps buy their next purchase or perhaps even just struggling to get into the market. Maybe they're fearful of just actually entering the market just given the way it is right now. I want this topic to be about it's time to get active. And there couldn't honestly be a better person to help me with this discussion. And that's a fan favourite of the Smart Property Investment audience is Paul Glossop.
Fan favourite? How do we poll a fan favourite?
A lot of different ways, I think, mate.
Okay.
I think it's because you keep coming back on the Smart Property Investment shows.
Yeah, I'll keep turning up. That's 80% of the job.
Exactly right. Exactly right. But just with that sort of topic, active in the market, we were talking just off air just before we jumped on here.
Yeah.
You've been buying throughout this year.
Yeah, but personally, definitely been buying. I've been super active. And if anything, it's probably been one of the more active, probably 6 months of my investing career personally. And aside from working with, I think we've probably bought over 150 properties for our clients in the 6 months leading up to the end of financial year 2020 personally, but I've probably acquired more in total value of property in the last 3 months than I have in the last 3 years. I mean, I'm working on probably the best part of $15 million worth of developments in Sydney as of the last 3 months, which are going to take me right through to the next 2 years. And it comes back down to opportunity. And this is the biggest thing that we always bang on about is understand where your finances are at. And it takes me a long time these days to get my finances in order to actually be able to execute. But the reality is I'm not spending my time personally trying to find, I guess, the opportunity to then say, once I get my finances ready to go, then I'll buy. I'm always working on getting my finances in order. And that's something that's an evolving discussion between myself, my broker, my accountant to consistently be ready to action or jump on opportunities. And in the last 2 or 3 months, buying some relatively large development sites, residential in the Sydney market and premium blue chip Sydney markets, which we've bought circa 2015 price points with the understanding that I can understand that how I can afford it from a cash flow perspective. I can see the ROI on it and knowing that it's going to come out of the ground and be finished in 18, 24 months, it comes back down to now's the time for me to execute.
I think probably the biggest standout there is, keyword is Sydney.
Yeah.
A lot of people might be listening to this and being like, no, I reckon you're probably making that up. How's that possible? Now, of course, Sydney isn't the only region that you work in. Of course, you work right across the country, correct?
Correct, yeah.
And I assume that there is obviously equally opportunity in many other, cities and states across the country as well, where this same scenario could exactly be happening.
Absolutely. And this is the big thing that we've always harped on is the fact that it comes down to A, what's the objective, B, what's the budget, and C, also when it comes down to diversification as well as where we're going to be able to find opportunity within. And right now, rattling off different property types and price points, we last week executed on a $162,000 property in Tasmania for a client with about a 7.5% yield. We're about to settle this week on a just shy of $1 million commercial asset in Canberra for a client, which is a large industrial unit with a 5+5 lease on it with about a 7.4% net return. We've also just literally about to sign off on a $230,000 asset freestanding house in Brisbane. We've bought 4 other assets in East Brisbane, North Brisbane in the last week and a half. We've bought 2 properties in Perth in that same time. And I guess the reason why I outline that is the fact that we're not just buying in a market because it's the most depressed or the most booming. It comes down to clients have got exposure in certain areas, clients have got certain budgets, clients have got certain objectives, and there are opportunities right across the country. There always has been, but there most certainly is more and more of that outlining here right now. The one market which I probably haven't outlined there intentionally is Melbourne. And I do feel for the Melburnians in the current state of play, but the reality is that there will be opportunity there. It's just not now. And you go through back, and I know Phil Tarrant had Tim Lawless on the SBI show very recently as well, and he made a very good point in the fact that, and this is where it comes down to, we can all talk about what the data suggests on where we are from a potentially a percentage capital growth position versus last month, last quarter, last year. But even if you take Melbourne in a classic example, it's more than 4% off its peak, but its peak was in March. But if you take where Melbourne is right now, it's actually also still over 3% above where it was this time last year. So it comes back down to property being a long-term play, and 1 year in property is not long-term. 1 year in property is literally just tying your shoes, getting ready to get on the pitch. You're a long way off actually maturing in that property. It goes back down to why you're buying property. Well, 95% of people who have money in property are holding that property for more. And I repeat that, 95% of property or people who are buying property are making money if they've held it for more than 7 years. So if you've not got a 7-year horizon, I personally would say don't bother unless you're actively developing. And even in that case, making sure that you've got an opportunity, a plan B to say if you hold it, because that will be something that you might have to do as far as can you afford to hold it if you don't get the outcome you want from a sale price.
Yeah. I think, look, we always bang on about, buying outside your backyard. And I think diversification in your portfolio is key to having a successful portfolio. Just on that topic of buying right across the country, you've rattled off quite a few cities there where you've been purchasing for your clients. I'm trying to get a picture here for, being an investor and a listener right now. If I was to come to you right now and I've got a dream, I go, I want to buy in Brisbane because everyone's talking about Brisbane. Yep. I want to buy here. How does the strategy meeting work with you? If I wanted to buy with you right now, how does it work and go, this is my dream, I want to buy here? Do you go, okay, well, we'll take a step back, actually perhaps where you currently sit right now in your financial situation, what things are going on in your life. Can you run me through the process of what that actually looks like for me if I wanted to buy with you? Yeah,
definitely. And I think it's pretty much the key part, Tom, from our side of things is saying, we need to understand, so you've talked about, you'd love to buy here. For me, it comes down to if someone says they want to buy their home here, that's great. And at some cases and in certain circumstances, buying that home as that first investment or that next purchase may make sense. But a lot of the time it is, I'd love to end up buying in that market, which is circa $1.5 to $2 million, because ultimately a lot of the time the aspirations do take us there. But the reality is that the first step or the next step can't be that. So there's got to be saying, well, do you wait 10 years to do that? Because the reality is if that market's $2 million now, if you're waiting 10 years, the reality is that market's probably going to be 3 to 4, potentially $5 million, depending on the market outcome and dynamic. So do you wait, save, because ultimately you're going to get priced out. So you're never actually going to get there unless you take other steps to get there. So the first step we always have to have is let's lay out status quo. And when we say status quo, we go through a laundry list of understanding where are you. Let's go through your income, your savings, your assets, your liabilities. Then equate that to saying what is your borrowing capacity based on status quo? Where do we want to get to long term? So let's talk about long term. And long term, I'm talking 15, 20, 25 years. And a lot of people's long-term goals, more often than not, won't be the same when you get to there. So we have to say, let's talk about our moonshot, knowing that that moonshot has to be revised typically every 12 months. But then let's say, hypothetically, if I want to buy my beachside property in Byron Bay and I want to dial down from my working career and have $100,000 income to then just literally go and surf the pass every afternoon and then eat in the side bowl and have a coffee and read a good book, which sounds, for 90% of listeners probably saying that's exactly where I want to be.
That's the dream.
But we're saying, look, great. And you're not going to snap your fingers and say you're there, because the reality is that is very unattainable for most. But there are a certain few wedge who work hard and execute on a goal to get there. So once we understand where we want to get to, regardless whether it's Byron or not, we need to know what that number looks like. So are we looking for a $2 million portfolio unencumbered? If so, we have to build out, if we're starting from zero, we hypothetically might need to build out a $2.5 million unencumbered asset base at 5% gross to then give us that $100,000 a year income. If we're starting with our first investment, can we go buy a $2.5 million asset at 5%? Very unlikely. So then we have to say, well, let's break it down. What asset types? What's the price points that we need to fill in that portfolio? And how long is it going to take us based on status quo? So if you're earning $100,000 a year, if you're saving $30,000 a year of that, if you've got no debts and you've got borrowing capacity of $700,000 now, let's then talk about the first investment. And then let's talk about the objectives of that. Typically, that might be we want to see capital growth in combination with cash flow, and it might be that it's $500,000. So out of that $500,000, where is the best market that we're going to be able to get that capital growth asset with that cash flow in mind that's going to allow us to A, gain equity, B, improve our serviceability to then replicate, then replicate, then replicate. So then the job is once we get that short-term goal, then we have typically anywhere between 5 and 8 markets, suburbs, local government areas, and rationale as far as where, what, and why, to then say, here's the markets, here's the property types. which we're going to suggest we want to execute on. Then we get alignment. Then our job is to go and source, secure, negotiate that property, typically off market, and then handle the entire settlement process. Okay. So start to finish, mate, that's probably what half an hour to an hour's worth of meeting we'll discover out of that conversation.
Okay, well, let's emphasise that a little bit more then. So is there a window right now that people have to buy in? Like I said right from the very beginning of this podcast, I've been hearing a lot of stories about people being, fear of missing out, or they were too uncertain to buy because they didn't know what was going on with COVID. Yep. I've been banging on about execution and making the decision now. Maybe they're struggling to do so. Maybe there's a completely different reason why. Is there a window? I want you to put a bit of fear into people here. Where people have to buy before it's too late.
It'll never be too late, but to put the anticipation on saying, I'm 38. And I look at my life, and there's probably been 3 distinct times in my actual lifetime where there was probably the best time to buy. And if I go back and say, look, to be honest with you, post-GFC, there was a boom. That was one of the best booms of the last 1.5 to 2 decades. Post or pre or just around the dot-com crash, there was another cycle that came out of that. And the recession of 91, 92, there was a growth cycle that came out of that. There's typically a decade cycle that comes out of this, and we're right in the thick of one right now. What we're going to have over the next 3-4 years is we're going to have record cheap interest rates. We're going to have the lowest amount of supply that we've had in this market for probably the best part of 15 years. We've got record low approvals, which have about a 2-year lag on when they actually come out of the ground. We're going to see the government throw more money at jobs creating infrastructure projects than we've ever seen in our lifetime. We're going to see immigration turn on like we've never seen it once COVID lifts, and we're going to see domestic migration also shuffle like we've never seen to chase jobs and chase infrastructure and chase a better life. What that ultimately is going to mean is that we're going to see probably a handful of markets, broader markets, and then suburbs within those markets over the next 3 or 4 years. I hands down will go on record to say that we're going to see some bull markets that'll come out of it. Now, don't expect that the next 12 months it's going to happen, but if you're looking at how do I make sure that I'm positioned best to get 15, 20, 30% capital growth by 2023 in that particular property, the time to buy is when others are sitting back saying, I want to see that market grow before I make any decisions. For me, that's the time where you'd ideally want to say, I made my decision. Now the job I have is to sit back, let the cash flow handle the investment, and let the property go and do its job. So yes, in theory, I would say that if you're looking and if you have an income that allows you to borrow money, if you have your buffers in place and you have an idea of where you want to get to, now is that time to execute. Especially if you're sub 40 and most certainly if you're sub 30. The reality is that you're not buying a $2 million asset and it's the one and only Hail Mary from halfway. You're literally buying that first step, or you might be buying the second or third step. You've got opportunity to keep replicating. This isn't your one and only opportunity. And worst case scenario out of this is that you're going to have cheap money, which allows you to hold these properties more or less. And we're going back off air talking about the fact that at the moment, $1 million mortgage at current interest rates, interest only for an investor, are the equivalent of around about $500 a week. When you start to absorb what that actually means to be able to hold assets, and this isn't just a short-term thing, the RBA has gone on record to say that they expect this is at least a 3-year cycle here. So you've got to make sure that you're factoring in saying, well, what happens if interest rates go up? They're not going up next year. They're not going up the year after. The reality is we've got 3-4 years before that happens, and it's only going to happen as we see inflation. And inflation happens, you're going to see rents increase. So if rents increase and interest rates increase, then you're actually still moving along that same parallel. So your holding costs still stay around about the same. So the fear of what people do have of that unknown should be mitigated dramatically by what's available now. So unequivocally, mate, time for me is if you've got your ducks in a row, execution is everything right now.
I love this. A few sentences ago, you said, happily put yourself on the sort of pedestal just there, because I can't wait for 2-3 months, a year even, for when we're talking about this again. And just sort of
and the market will start to turn and people will say, I've missed it. And it's a mug's game. If you're trying to pick the bottom of the market or the top of the market, it's a mug's game. That ultimately comes back down to what we said earlier, is that if you're not buying property for a minimum 7-year hold, don't buy property. Unequivocally, I'm not comfortable in anyone thinking I'm going to make money in 2 or 3 years and exit, because the entry and exit costs are always far too cost prohibitive. So if you're not invested for a 7 to 10 year minimum time frame, property's not your vehicle. Go and play the shares equities market, and I can guarantee it's a much more of a white knuckle ride going down that pathway, and expect that your money can make or break you within a matter of days and minutes even.
Yeah, couldn't agree more. So how, from a listener's perspective again, you might have said a few things right now that might have shaken people up a little bit. They might even disagree with you. But how can people actually get in touch with you? to either have their first strategy session with you, or perhaps, shoot you a few questions, or perhaps even argue with you? How can they get in touch?
Yeah. I'm all for proactive and constructive discussion and arguments, because I post a lot of stuff on socials, on LinkedIn, on Insta, on Facebook, etc. So if people do want to have a look through there, and a lot of stuff that I've been posting on, specifically data sets, then jump on our socials at Pure Property Investment. You'll find us everywhere and posting different things on a daily basis. But if people want to get in touch with me directly, they can actually contact me directly and set some time up with me directly as well. They can jump on purepropertyinvestment.com. There's an inquire now button, and that literally takes them straight to my calendar, and they can book in half an hour with me to have a chat about their circumstances and how they can actually talk about what to do in the short, medium and long term. And we then give our 2 cents on how to put that strategy into action and get there. And even if they've got questions or want to argue the point either way of the ledger, they're absolutely more than happy to go through that process. And we're here on a day in, day out basis to go through that process, because that's our job, is to set strategies and execute on those strategies to get for far better outcomes in the long term.
Fantastic. In addition to this, if you want to hear more of, or you want to pick more of Paul's brain, you can find a plethora of his podcasts that he's been with us now for, years and years and years on Smart Property Investment.
Since the start.
But his most recent podcast, he did do a Q&A with us August 17th. If you want to go check that out, please do. And you can also find Paul scattered across the Smart Property Investment website as well. So if you want to just read a story, listen to a podcast, or perhaps even click on an ad, you can get in touch with him that way too. Paul, thank you so much for joining us.
Oh, you're welcome, mate. Thanks for having me again.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.